I used to think my perfect credit score meant I was winning the money game, until I realized I was just the most profitable customer for the credit card companies. They don't want you to default. They want you to stay perfectly, comfortably in debt forever. Today, I'm revealing the psychological tricks lenders use to turn your high score into a lifelong debt sentence. Take Diana, 47, credit score of 802, the kind of number people brag about at dinner parties. Last year, she paid just under $14,000 in interest. Not because she missed a payment, not because she did anything a lender would call a mistake, because that score was never a reward for being responsible. It was a signal to the banks that she was safe to keep lending to, forever. If you are part of the people who are of the opinion that your high credit score means you've made it financially, then I am about to expose the lies and tricks keeping you hostage. Hit the subscribe button and turn on the notification, because this is exactly what this channel is built for, and you don't want to miss the next one. Here's what almost nobody understands about the number they check every month. Your credit score was never designed to measure how much debt you're in. It was designed to measure one thing: the ratio between what you owe and what you're allowed to owe. That's called utilization, and it is the single biggest lever on your score after payment history. That is not a small distinction. That is the entire trick. Diana carries $16,500 in credit card balances. That sounds like a debt problem, but across her cards, she's been approved for $95,000 in total credit. 16.5 against 95,000 is roughly 17% utilization, which looks excellent to a scoring algorithm. The algorithm isn't asking how much do you owe, it's asking how close are you to your limit. Diana could owe 5 figures in interest-bearing debt and still look, on paper, like one of the safest borrowers in the country. That is not a typo. Meanwhile, Marcus, same electrician from the last video, same disciplined instincts, carries a lower score, 718, mostly because he only has 2 cards and a shorter credit history. But Marcus pays his statement balance in full, every single month. $0 in interest, ever. Diana's score outranks his by nearly 90 points. His net worth trajectory outranks hers by a much larger number. Then there's Priya, 51, whose credit limit has been raised 4 times in 6 years without her ever asking for an increase. Each time, it felt like a reward for good behavior. She now carries roughly $9,000 across 2 cards, a balance that's grown quietly alongside every increase, without ever once feeling like it was growing. And Tom, 39, who chases cash back and travel points across 5 different cards, convinced he's beating the system every time a statement credit shows up. 4 different relationships with the same 3-digit number. And here's what should bother you about that. All 4 of them were told the exact same thing by the exact same industry, that the number is the goal. Diana was told to keep her utilization low. Priya was told to say yes to limit increases. Tom was told to use his cards for everything so the rewards would stack up. Every piece of advice, on its own, sounded reasonable. None of it ever mentioned what the number was actually built to measure, or who benefits most when it goes up. Now watch what the number was actually built to protect, and it isn't you. Let's go back to Diana and the first mechanism, the utilization illusion. It was not her balance that made her look safe. It was the size of the limit sitting underneath it. Every time Diana's issuer approves her for a higher limit, her utilization percentage drops automatically, even if her actual balance never changes. Her score improves. Her interest bill does not. Run the numbers on what she's actually paying. At an average interest rate of 22% on a revolving 16.5, she's paying roughly $3,600 a year just to carry that balance in place. And because she's making payments closer to the minimum than the payoff, more than half of every payment she sends is interest, not principal. Her balance has barely moved in 3 years. Her score in that same window went up. Here's the rule worth remembering. Your credit score was never built to measure your freedom. It was built to measure how safely you can be lent to. Now to Priya, And a second mechanism, the credit limit increase as a leash, not a reward. It was not generosity that raised her limit 4 times. It was math. A higher limit doesn't just lower her utilization on paper, it raises the ceiling on how much debt she's psychologically comfortable carrying. Priya described her most recent increase as finally being trusted. What actually happened is her issuer calculated that she could safely absorb more revolving debt without defaulting, and extended exactly that much rope. Not this, a compliment. Actually this, a recalculated risk ceiling, dressed up as one. Here's what nobody tells you about that structure. The credit card business does not make its money from people who pay in full, like Marcus. It barely makes money from people who default and stop paying entirely. Those accounts get written off as losses. The actual profit center is the customer in the middle, someone reliable enough to keep paying, but comfortable enough to keep carrying a balance indefinitely. Diana isn't the exception to the system. Diana is the business model. Now to Tom, and the rewards illusion, the third mechanism, and maybe the most emotionally convincing one. It was not free money he was earning every time a cashback statement credit landed in his account. It was a small percentage handed back to him, funded by the much larger percentage being extracted from cardholders who carry balances. Tom earned roughly $700 in rewards last year. He also carried a balance 3 separate months to cover holiday spending and paid nearly $900 in interest doing it. Read that again. He was, on net, paying the credit card company for the privilege of collecting points from it. That is not a math error on Tom's part. That is the entire design. Rewards programs exist because they make responsible-looking spending feel like a win, which keeps cards in wallets and top of mind, which increases the odds that a balance eventually gets carried, even by someone who swore they never would. There's a fourth mechanism worth naming, the minimum payment trap, hiding in plain sight on every statement. The minimum payment listed is not calculated to help you pay off your balance. It's calculated to be the smallest number that keeps the account technically current and the interest clock running as long as possible. On Diana's 16.5 balance, the minimum listed is roughly $330. At that pace, making only minimums, it would take her over 11 years to clear a balance she stopped adding to years ago, and she'd pay more in cumulative interest than the original balance itself. Compare that to what happens if she pays just $200 a month above the minimum. The payoff timeline collapses from 11 years to under 3. The total interest drops by more than 70%. Nothing about her income changed. Nothing about her limit changed. The only thing that changed was which number on the statement she decided to treat as real. And a fifth, the just this once reset. Every one of these 4 people, at some point, treated a limit increase, a 0% promotional balance transfer, or a rewards bonus as a clean slate, a reason the old math no longer applied. It always still applied. A balance transfer doesn't erase debt. It relocates it, usually with a fresh clock and a fee, and the psychological relief of a lower number on one statement quietly becomes permission to spend on the card that's now sitting empty. Now, the psychology, because this is where the trap actually lives. Nobody checks their total annual interest paid the way they check their score. The score is gamified. It's a single number, it goes up, it feels like winning, and apps push notifications the moment it improves. Interest paid isn't gamified at all. It's scattered across 12 monthly statements, in a font nobody enjoys reading, never summed up anywhere the algorithm wants you to see. Diana can tell you her score to the point. She could not tell you, before this video, that she paid nearly $14,000 in interest last year, enough to fully fund a retirement account contribution, gone, to service debt on things she'd already finished using. There's a pride element sitting underneath all of it too. A high score has become a kind of financial status symbol, something people mention the way they'd mention a job title. That pride makes the number feel like the goal itself, instead of what it actually is. A byproduct of behavior the banking system finds profitable to encourage. It shows up in small ways that feel harmless. A screenshot of a score increase shared with friends. A sense of superiority over someone with a lower number, even if that person owes nothing and pays no interest at all. The score has become a proxy for financial identity when it was only ever supposed to be a proxy for lending risk. Those are not the same thing, and the gap between them is exactly where Diana, Priya, and Tom have all been quietly living. So go back to Diana, 47 years old, an 802 credit score, $14,000 in interest, paid quietly, for the crime of doing nothing a lender would ever flag as a mistake. The paradox from the beginning was this: how can the number everyone tells you to protect also be the number that's quietly bleeding you? The answer was never that Diana was irresponsible. It was that she was optimizing for a score built to measure her reliability to lenders, while nobody ever handed her a number that measured her progress toward actually being debt-free. Here's the one sentence worth remembering. A high credit score doesn't mean you're winning. It means the bank is. None of this means the score doesn't matter. It opens doors. It lowers rates when you do need to borrow. But Marcus proves the fix isn't complicated. He didn't sacrifice his score to escape the trap. He simply stopped treating current as the same thing as paid off, and it's worth roughly $3,600 a year that Diana is still quietly handing over. The fix isn't dramatic either. It doesn't require closing accounts or swearing off credit entirely. It requires one shift. Start tracking the dollar amount of interest you pay each year with the same attention you give your score. One number tells you how trustworthy you look to a bank. The other tells you how much that trust is currently costing you. Only one of those numbers actually belongs to you. If this showed you something you did not know was happening with your money, subscribe to Robin Wealth and hit the bell. We break down the hidden math behind the financial decisions you face every single day. Your score was never the finish line, your balance was. Make the decision that matches your reality, not someone else's sales pitch.